Hello, I'm Emilie Bellet, founder of Vestpod and author of You're Not Broke, You're Pre-Rich, and you're listening to The Wallet. Every week we give you the best tips, guidance, and a good dose of inspiration and motivation to manage your money better. Today we're answering a question from one of our Money Matters Festival attendees, who wanted more information about building her first portfolio of investments.
More kind of information in terms of how to invest in what to invest in and the right time to invest in shares and funds and all of that kind of stuff. When is it the wrong time or the right time, when to start and things like that. What to invest, how much, do I put a bulk sum in one fund, do I, whole thing around diversifying and all of that.
So whether you're starting from scratch or looking to refine your strategies, I've prepared this 10 steps checklist to understand and select your portfolio. We'll be talking about risk rewards, asset allocation and diversification, balancing a portfolio, having a more passive approach with funds, and also monitoring. Don't worry, there's going to be a little bit of jargon, but I'm going to try to explain all these concepts and try to give you very practical tips. If you want to share some tips with us or have any questions you'd like us to cover on the show, email me at podcast@vestpod.com. Remember, you can also find the transcript of this episode on vestpod.com. Remember that we are not certified financial advisors. Information shared in this podcast is for educational purposes only and does not constitute financial advice. PensionBee is on a mission to help pension savers across the UK. Each month, their Pension Confident podcast helps listeners understand the world of personal finance, exploring pensions, ISAs, mortgages, and more. Host Philippa Lamb is joined by a panel of expert guests who answer questions from can you afford to have kids to should you invest in a pension or an ISA. The Pension Confident podcast is available right now wherever you get your podcasts. Just remember that anything discussed should not be regarded as financial advice, and when investing, your capital is at risk. Okay, so let's dive into portfolio building. Today, we're taking the DIY route and look into a more hands-on approach to investing. I know you may be scared or eager to get started, and maybe you've already heard a tip or two from a well-meaning friend. But hold on a second. Before we jump into the excitement of picking stocks or funds, let's hit pause and rewind back to your investment goals. So remember, whether you're dreaming of, retirement, setting the stage for your children, for future generation, or chasing some very specific financial milestones, and I'm thinking buying a home or funding education, you need to have these clear objectives. We are focusing at Vestpod on long-term investing. That's opposed to day trading and trying to make money very quickly. And with these goals in mind, I'm sharing the 10 essential steps I use to understand and build my portfolio. We won't cover taxes in this episode, but we are preparing a where to invest in UK for tax efficiency with stocks and share ISA, pensions, lifetime ISA, so you can tune in to one of these episodes. 1. What is an investment portfolio? So think of your investment portfolio as really like a basket containing assets, and I'm going to explain what assets are, that you expect will increase in value over time and also potentially pay you an income. The goal is to grow your money and outpace inflation. So what do you find in a portfolio? Usually you have 4 main asset classes: stocks, also called equities, bonds, cash, and property. So stocks represent ownership in a company. You own a piece of a company, can be a powerful way to build wealth, especially over the long term. But it's also one of the riskier of these 4 asset classes. Then you have bonds. They are debt securities. They are loans issued by companies and government. They offer a little bit more stability to your portfolio, especially during uncertain times. However, high inflation can also affect their performance. Then you have cash. Cash refers to money that is available for spending or investments. It provides liquidity and also some stability to your investment portfolios, and it will allow you to access funds quickly and easily when needed. And the 4th main asset class is property. And property is often accessed through funds, because here we talk about stock market investing, and I'm thinking real estate investment trust, REITs, involves investing in real estate such as buildings, land, or infrastructure. and allow investors to buy shares in portfolios of real estate properties managed by professionals. So these are the 4 main asset classes you will want to see in your portfolio. 2, let's talk a little bit about risk. When you invest money, there will be a risk involved. We often see risk as something negative, but it also presents opportunities for growth. Investments with higher risk potential typically offer the possibilities of greater returns over the long time. So the risk tolerance, how you feel about risk, this will be based on your ability and your willingness to endure fluctuations in the value of your investments. So it's always a little bit a balancing act between the potential for higher returns and the possibility of losing money. So when I assess my risk tolerance, I usually look at 3 things: my goals, how long do I have until I want to reach my goals, and how do I feel about market fluctuations. So let's just take an example. If I'm saving or if I'm investing for retirement and planning for, several decades away, I may be able to tolerate higher level of risk in my portfolio because I have more time to weather market fluctuations. And we'll talk about portfolio building, but when I want to take more risk with my investment is usually that I have a higher portion of stocks or equities in my portfolio. But now, if you have shorter term financial goals or like a lower tolerance for risk, or if you're getting, let's say, you're getting closer to retirement, you may prefer a more conservative investment approach and you focus on capital preservation, and that means you may want to have more bonds or more cash in your portfolio. When we invest, why do we want to invest? It's just because we want to make our money work harder and we hope our investments will appreciate in value. But as you know, it's impossible to predict which assets will perform well in the future. So we need to diversify. It involves spreading our investments across different asset classes, we talked about that, but also different regions, different sectors, different styles. If we use, active and passive funds, for example, reducing the impact of any single investment performing poorly. 3, why can't I just buy one share in one company? Okay, let's go back to a very simple analogy. Imagine you have a basket and you're putting all your eggs in it. If you drop that basket, all your eggs could break, right? Diversification is like having several baskets, each with some eggs in them. And if one basket falls, you won't lose all your eggs at once. In investing, it's the same idea. Instead of putting all your money in just one thing, like one company stock, just buy one, one stock in Tesla, one stock in Apple, you spread out into different things. Stocks, bonds, real estate, maybe a bit of cash, different sectors, different industries, different geographies. That way, if one investment doesn't do well, the others can help balance it out, reducing the risk of using all your money at once. Now, how do I define my asset allocation? What is the rule of 100? This rule suggests subtracting your age from 100 to determine the percentage of your portfolio allocated to stocks. However, because we're living longer and retirement may be further away, some experts suggest that we adjust this rule. And instead of calling it the rule of 100, let's call it the rule of 120. This means having a larger proportion of stocks compared to bonds. Let's take an example. If you're 30 years old, following the rule of 100 would entail allocating 90% of your portfolio to stocks and 10% of bonds. So 100 and the rule of 120, take away 30 years old, equal 90. 90% of your portfolio is invested in stocks and the remaining 10% is invested in bonds. If you're 10 years older, say you're 40 years old, you might consider a distribution of 80% stocks and 20% bonds. This suggests that you should consider taking on more risk while you are young and gradually decrease risk exposure as retirement approaches. Because of the reduced ability to generate income and the limited time available to recover from investment losses as you near retirement age. Just remember that this is just a rule, a benchmark that you can use for your own portfolio, but it's not perfect and it will depend on your personal circumstances. But I just think it's a good guide in terms of trying to understand how do I diversify my portfolio and what is going to be my balance of equities versus my balance of bonds in my portfolio. 5. What is passive investing? Passive investing, often advocated by Warren Buffett, involves investing in funds that track market indices like the S&P 500 or the FTSE 100 instead of trying to beat them. In contrast, active investing involves managers attempting to outperform the market by selecting stocks or timing trades. However, research consistently shows that most active investors fail to beat the market after accounting for fees. That's why I tend to favor passive investing, especially if you're new to investing, because it's simpler, it's quite cost effective, and you can get this broad market exposure and diversification. But remember, even if you're a passive investor, you will need to actively manage your portfolio and rebalance it periodically, but avoid overreacting to short-term market fluctuations, as this can impact return. It's usually best to set your strategy and check in regularly rather than making frequent changes. I really like this quote from Warren Buffett that said, by periodically investing in an index fund, the know-nothing investor can actually outperform most investment professionals. So once you've decided on your asset allocation, we're going to be looking at, what funds can I invest in? I know delving into funds can be a little bit daunting, but let's get into it. 6. What can you invest in? Index funds and ETF exchange-traded funds are popular choices for passive investors because they offer broad market exposure with low fees. These funds hold lots of different stocks or bonds, so you're not putting all your money into just one company or investments. And by picking a mix of these funds, you're spreading your money across different parts of the stock or bond market. Let's go back to our rule of 120. You can implement the rule of 120 by investing in equity funds and bond funds rather than selecting individual stocks and bonds. For equities, opt for diversified index funds or ETF that track broad market indices. This will provide an exposure to a wide range of companies across different sectors and regions. You can always look for low-cost funds with a solid track record and consider well-established name in the industry. For bonds, you can consider bond index funds or ETF that offer exposure to a mix of government and corporate bonds, and you can have different maturities and credit qualities to diversify risk. 7. Make your own research. I tend to leverage online investment platforms that offer pre-made portfolios or model portfolios tailored to different risk profiles. These portfolios will include a mix of equity and bond funds created by investment professional or by an algorithm, making them quite a convenient starting point for beginner. I also use investment research websites and tools to compare fund performance, fees, and other key metrics. So for example, TrustNet, Morningstar. You can look for funds with low expense ratios, consistent performance, or history of tracking their respective indices closely. You can look at fund ratings and reviews to try to get an investor sentiment and confidence in the fund manager's abilities if you look at active funds. You can look into KID and fact sheets. But now something that's been quite helpful is looking into multi-asset funds. When you invest in a multi-asset fund, you're putting your money into a mix of different things like stocks, bonds, cash, all in one go. This diversity brings value as assets will behave differently depending on the market context. So it's about looking at these decorrelated assets that make your portfolio more resilient to face an uncertain future. They're like a middle ground between risky stock funds and safer bond funds, and they offer decent growth potential while keeping the risk lower than going all into stocks. An interesting thing also when you're looking at different types of funds is looking at either accumulation or income funds. And it's all about how you want your returns. So accumulation funds automatically reinvest any profits back into the funds, aiming to grow your investment over time. On the other hand, income funds pay out regular dividends or interest to investors, providing a steady stream of income. Both types of funds can be trackers, meaning they passively follow an index like the FTSE 100 to mirror its performance. So whether you want your money to grow or need a regular income, there's going to be a passive option for you. 8. How much should you invest? Deciding how much to invest depends on your own situation, whether you're just starting to save, already saving, or getting close to retirement. It's a good idea to stick to a plan of, spending less that you earn, of course, and adjust your investment strategy to fit your goals and how comfortable you are taking risk. Think about what you want to achieve with your money and how much you can realistically set aside for investment. Remember that even small amounts can grow over time thanks to the magic of compound interest. So you may be starting out with £200 a month, £500 a month, £1,000 a month. And this journey really starts with this first investment. I'm going to show you a few examples, and I'm here assuming a rate of return of 7%. However, it's important to remember that, past performance, and this is, the S&P annualized return since 1971 has returned 7.58% or 10.51% with dividend reinvested. But this doesn't predict that you can expect this return every year. So some years stocks are up, whereas in others they can fall. And this annualized return is just an average earned over a period of time. So in my first example, let's say you start with £100 a month, you invest for 20 years with this average return of 7% per year, you could end up with around £52,000. If you increase this investment and instead of investing £100, you invest £200 a month, you will get to £105,000. But if you increase your investment to £500 a month, you could potentially grow your savings to over 260k over 20 years. That's the power of consistent investing and letting your money work for you. I think reaching this first 100k in investment is a significant milestone because at this point, the compounding effect starts to accelerate, meaning your money begins to grow faster thanks to the power of compound interest. So if we go back to this investment, let's say of, £200 a month, it will take you 19 years, almost 20 years, to reach this first 100k. But now to go from 400k to 500k, it will take you 3 years. And to grow from 900k to 1 million, it will take you 1 year and 7 months. So you see how generating 100k will be faster over time. And the total time to reach 1 million when you invest £200 per month will take you 49 years and 11 months. Now, if I increase my investment and if I invest £500 a month, to reach my first 100k, it will take me 11 years and 3 months. And to reach 1 million, in total, it will take me 37 years. How I've done this, you can use an Excel spreadsheet, but there's a lot of compounding calculators online. So feel free to use one, plug your own numbers, and you can get a more personalized estimate with your own assumption. And as you can see, reaching the first 100k may be the most challenging part of your journey, but it's also when the power of compounding truly starts to work is magic. 9. Starting small and embracing mistakes. Remember that investing is a journey and it's okay to start with smaller amounts as you learn and gain confidence. I quite like the idea of starting with small numbers and give yourself the right to make mistakes. We all make mistakes and then we can learn and refine our investment approach to become more knowledgeable over time. By starting small and even starting with a robo-advisor, you can test different investment strategies, you can learn from any mistakes you make and gradually improve your investment contribution as you gain experience. And finally, 10 is to monitor and review your portfolio. You can keep an eye on your investments, meaning you check them regularly to see how they're doing. This can be every 3 months, every 6 months, or every year. If they've strayed too far from what you originally planned, you might need to adjust things. And this could involve selling some investments that have done well, potentially when you want to rebalance, and buying more of those that haven't or still have a lot of potential to rise to keep everything balanced. It's really important to resist the urge to constantly tinker your portfolio. Sometimes leaving it alone is the best strategy. Ignore the noise, and especially on social media. Your portfolio is not set in stone, and you may need to adjust its allocation accordingly, especially when your portfolio is made of equities and bonds, and when equities tend to perform better than bonds, the initial allocation that you had that may be 90% 10% or 80% 20% may change, and you may have a higher proportion of equity of stocks and a lower proportion of bonds. And if your goals haven't changed, you may want to go back to your initial allocation. In conclusion, keep things nice and simple. In this world of investing, there's no one size fits all, and each of us has a unique journey. So choose a strategy that feels right for you, aligning with your goals or your dreams, but also your comfortable level of risk and your personal situation. Remember that what works for one person may not work for another. So do your homework and don't hesitate to seek advice also from financial advisors. They're here to support you every step of the way. And if you need a little bit of support in building your first portfolio, that's what we do in our investing bootcamp. We're going to be launching the next one very quickly, but also don't miss out. We send updates on the newsletter. We're releasing podcasts. We have a lot of content on Vestpod.com to try to help you get to a stage where you can start investing money. Thank you for listening. Before you move on to your next listen, copy the link to this episode. We're trying to get financial education to women, but we need your help to do that. So if you enjoyed this episode, send the link to a friend who might learn something from it too.